Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q4 2019. And this morning we'll introduce three very knowledgeable economists and experts, two from Moody's and one from Experian. They have each done a deep analysis of Experian's Q4 business credit data published in the most recent Experian Moody's Analytics Main Street report. And this review will be presented in three segments. We'll be discussing key findings in the Experian Moody's Analytics Main Street report for Q4 2019, as I said, and the review will be presented by Brody Oldham, Senior Director of Analytics, and presenting from Moody's will be Ryan Sweet, Director of Real-Time Economics, and Associate Economist Derek Grunfelder-McCrank. To make sure you get the most out of today's session, please use the Q&A applet in the WebEx tools, and we'll try and leave time at the end. We have a full agenda today, obviously, with what's going on in the economy. So if you would like to download a copy of the slides, we will have a link distributed afterwards to you. You can follow along with us if you like. We're going to kick things off right away and turn things over to Ryan from Moody's. I'm going to pass the control to you, Ryan.
So I was going to start off and give everyone a brief update of our baseline forecast, which is what we view as the most likely outcome. But given the situation with the coronavirus, things are changing very rapidly, almost on a day-to-day basis. We are monitoring the number of reported cases, both in the U.S. but internationally, the number of cases in the U.S. by region, and this is helping us assess both the economic impact, but also the risks to our forecast. And we are in our baseline, we don't have a recession penciled in. But I do think, and I want to highlight that the risks have increased quite substantially over the last week and a half, and we are debating whether or not to adopt a recession. Now, to kind of put everything in a historical perspective, we usually adopt a recession when the odds of a downturn are 66%. Currently, our probability of recession models, we have various ones, they're ranging between 50 and 60%. So we haven't hit that threshold yet. But we are in unusual times. A lot of our models are driven by either financial market data or hard economic data. And the impact of the coronavirus isn't showing up in the hard economic data yet. We have, for example, this morning we just got industrial production for February. Where you are seeing the impact is in measures of consumer sentiment, business sentiment, and investor confidence. We're tracking daily consumer confidence by morning consult. That has fallen sharply. That's likely attributed to both the coronavirus and also the sharp declines in equity prices. We're looking at box office revenues on a daily basis, and they've fallen noticeably. So we are starting to see evidence that in March the impact of the coronavirus has intensified. So on the next slide, and this is kind of just laying the groundwork, and this is a map of the globe, and anything that's colored green is an economy that's growing near their potential, and this was as of our March 2020 baseline, which we updated in the first week of the month. Things that are, we'll call it orange, are economies that are growing below their potential. So you can see the U.S. we have growing below its potential. And you can see that if you look at average GDP growth over the last few quarters, it's shown signs of weakening. We have an estimate of monthly GDP, and monthly GDP in January was okay, but it was consistent with an economy that was growing sub its potential growth rate. And we put the estimate of the economy's potential growth rate at roughly 2%. And why that's important is that when an economy is growing, below its potential growth rate, even just by a little bit, you're vulnerable to anything that goes wrong. And throughout this expansion, we've weathered a number of ups and downs. The European debt crisis, natural disasters in Japan, natural disasters in the United States, the taper tantrum. So we've gone through a lot, and the expansion has lived on. But the coronavirus is a different test. And given that the economy was vulnerable, we're going to really feel the impact in March, April, and into May. And then the countries that are in red are those that we believe are in recession. So Japan's in recession, Italy's in recession, and we just switched that one over recently, given the coronavirus and the country's decision to go on lockdown. Now, from an economic perspective, that's very costly, but from a public health perspective, that was the right thing to do. And that's why other countries are following suit. So I wouldn't be surprised that you start to see some of the green countries shift into growing closer or below their potential, and then some falling into a recession. Europe is slowly shutting down in response to the coronavirus, and actions in the United States are not as aggressive as we've seen in other parts of the world, but they are ramping up the social distancing, school closures. For example, my kid's daycare is closed for the next 2 weeks. They're thinking maybe possibly 8 weeks, and that's disruptive to the economy. And it's going to feel like a recession to many people, particularly those that are on the front lines, those restaurant owners, those in services, people that work hourly. They're going to see their hours cut. Businesses are going to start laying off workers, and the key really is to assessing the risk of a recession. Not only just the risk of recession, but the severity, the length, if a recession does happen, is the policy response. And we're seeing an aggressive policy response across the globe. And the U.S. has been slow to respond, but it's really kicking in. And we'll dive into what the fiscal and monetary response has been so far. But the policy response is key to avoiding recession. You can see countries that didn't adopt that, in the prior slide, have fallen into a recession. And what I wanted to highlight in this slide, and it looks very concerning, but I want to, caution, is that with our forecast, there's a tremendous amount of uncertainty. We don't know how this is going to unfold. We can't, forecast how the coronavirus is going to develop in the U.S. and in Italy and in other parts of Europe. So there's a tremendous amount of uncertainty. So our baseline forecast is essentially we're forecasting the best, but we know that there's worse or alternative scenarios. So we created a pandemic scenario. And in this situation, by the description, doesn't mean, when the WHO adopts the definition of a pandemic, that we're going to switch our forecast to this. This is just a very severe situation where the coronavirus is widespread. The number of cases don't peak until late June, July, and it's very disruptive to the global economy. And you can see that many countries will fall into a recession. And you may be wondering, why there are a couple of green countries, and it's just timing, because this would be a recession in this year. If we extended this out to 2021, first half, those green countries switch over to being red. So best case scenario, which we still think is our most likely outcome, but we're not overly confident, is that we skirt a recession because of the policy response that's coming from the Federal Reserve and fiscal policy. And you can see the aggressiveness of the Fed in the next slide. And the Fed is panicked, and they have aggressively cut interest rates. And the problem here is the Fed's doing the right job, but there are limits to monetary policy. And this is one situation, given that we have both a significant supply shock, demand shock, and a public health crisis, that monetary policy can only do so much. And there's also, the Fed didn't have as much room to cut interest rates this time around as they had in the past. And you can see in this chart, the blue bars are the inter-meeting rate cuts. And they've been pretty rare. So since 1998, there's only been several of them. Most of them occurred during the Great Recession. The green bar is what the Fed did at the next scheduled meeting, and you can see that this time around in March 2020, Fed on March 3rd cut interest rates 50 basis points. They followed that up last Sunday by cutting by 100 basis points. They moved forward their regular scheduled meeting. In addition to that, they restarted quantitative easing. Quantitative easing will help lower long-term interest rates, but given the 10-year Treasury yield is below 1%, QE will pack much less of a punch this time around than it did during the financial crisis. This morning, the Fed announced that it's launching its the commercial paper facility. This is an important move. Commercial paper market, if that freezes up, then the economy would have much more substantial issues. The Fed's trying to make sure that markets, the bond market, the commercial paper market, the mortgage-backed securities market, all continue to function. So the primary role the Fed is playing now is not necessarily to stimulate the economy and by lowering interest rates, which is its primary lever. It's making sure that there's enough credit flowing in the system. And with regards to QE, they're going to buy $500 billion in treasuries, $200 billion in mortgage-backed securities. What they could do next, that's the key question I get from a lot of our clients is, the Fed's at zero, now what? They can continue to use credit facilities, so they could dust off the TALF, this term auction lending facility. They can move to open-ended QE, aggressive forward guidance, and that combination right there is a form of yield curve control. So the Fed would really commit to keeping interest rates throughout most of the yield curve low for an extended period of time. Besides that, they could loosen some of the regulatory requirements on banks to make sure there's more lending to small businesses, which is really critical, and households, which is also very important. So the Fed's not a bystander by any stretch of the imagination, but the burden on boosting the economy, and when we get through this soft patch, when the coronavirus does pass, that the economy does bounce back pretty quickly, is on fiscal policy. And you can see that in this slide. What I'm showing you here is federal discretionary non-defense funding for emergencies, and that's a mouthful, but basically what it is funding that's directed towards emergencies. And this is for the fiscal year. And the big spikes in the bars that you can see all correspond with natural disasters. And you can go back to Hurricane Katrina and see a large increase there. So 2018, there was a bunch of hurricanes, 2017 and 2013. The initial orange bar is the $8.3 billion that was allocated towards the coronavirus. And that, we knew that was not enough, and that paled in comparison to what would happen in past natural disasters. The good news is that, I think, one thing that the Fed got through by panicking and cutting rates all the way to zero is they really put the pressure on fiscal policy. And you can see that lawmakers are beginning to act. So a bill is passing the House. There's a bill in the Senate. President Trump this morning, and Treasury Secretary Mnuchin announced plans that they're going to actively try to get money into people's pockets immediately, and that's good. That's a good news because that will help cushion the blow to the economy, and then also once this period passes, it should strengthen the recovery from the impact of the coronavirus. So they're debating whether or not to send checks to individuals, to households. They're trying to get money to small businesses, which I think is very, very important. They're going to help the airline industry, the cruise industry, things that are on the front line. But one thing that is a must is the extension of unemployment insurance benefits, paid sick leave. All these seem to be in the pipeline. And I think the economy is really going to feel a big boost from the fiscal stimulus once we get on the other side of the coronavirus. So one thing I did want to point out, and I'm not, I don't want to scare everybody, but I think it's important to put things into context, is that if we're wrong and a recession does follow, and it does seem like we're getting closer and closer to being forced to adopt a recession as our baseline. Again, we're not there yet. Things are changing very, very quickly, but I wouldn't be surprised if we do adopt a recession as our baseline at some point in the near future. If we do have a recession, though, we got to keep it into perspective. It's unlikely going to be a 2007, 2008 situation again. That was a normal recession thrown on top of a financial crisis. So that was very, very severe. And the way to interpret this chart is this is the percent change in GDP since the beginning of the recession. And you can see, looking at 2007, that was, we fell hard and we stayed low. The recovery was very, very weak, and it took time. So this is your, check mark type recovery. Another form of recovery would be a U-shaped recovery, where you fall quickly, you bottom out, and then the economy bounces back. There's also a V-shaped type recession, where the economy drops very, very sharply, very quickly, and then springs right back. It's very difficult to predict the shape of what a recovery would look like. If the catalyst for the next recession is in fact the coronavirus, but it's more likely would be something closer to a U-shaped type recovery, where you have a lull in economic activity, and then things begin to bounce back, particularly given that we have a tremendous amount of monetary stimulus in the pipeline. Fiscal policy will be kicking in, in short order. But recessions, the average is about 18 months. And all we can do right now is kind of put things into historical perspective, because the coronavirus is, it's a black swan event. It's something that came out of left field and hit the economy. And then finally, I wanted to wrap up with looking at the job market. And just to forewarn, the next couple of months, the job numbers are going to look pretty awful. Not necessarily because businesses are laying off a lot of workers. I mean, you hear anecdotes that some businesses are furloughing workers because of the coronavirus. It's going to be mostly because hiring came to a screeching halt in March, and that's likely going to feed into April. So we're going to see a couple months of pretty bad job numbers. But the thing I wanted to point out is, if you want to try to assess the magnitude or the severity of the coronavirus and its impact on the job market, don't wait for the monthly job numbers or the unemployment rate, which is also monthly. Watch jobless claims. They're a weekly data series. They count the number of people that are filing for unemployment insurance benefits, and that is a very good sign barometer of the strength of the job market. But all in all, just to summarize, the economy, we've gotten hit by a black swan event. Things are going to feel uncomfortable for a period of time. We don't know how this is going to unfold, but right now, again, our baseline forecast is we don't have a recession. We have very little growth in the first half of this year, barely skirting a recession, and the economy bounces back in the second half. But again, we're monitoring these things on a day-to-day basis, and we view the risk of a recession as increasing quite significantly over the last couple of weeks. So with that, I'll turn it over to Derek.
All right. Thank you, Ryan. I just want to start out by saying, thank you to our partners at Experian. The data that they provide us really unlocks a whole lot of value and insight in terms of getting a good view into the small business credit market. Their data does a very good job of covering the universe of small businesses that exist in the U.S. They very closely match what the Census Bureau, reports as the complete universe of small businesses, and this data set really lets us dive deep into the meat and bones of what happens in the small business credit space. So without further ado, let's move into the numbers. So keep in mind that our most recent data is as of Q4, so we aren't seeing a whole lot of the strain that's likely to come in the first half of the year in these numbers. So in Q4, medium-term delinquencies, or 31 to 90 days past due, among all small businesses in the U.S. was about 1.6% of outstanding balances. Again, this was in Q4. It was only a mild uptick from the third quarter, and we likely won't see a whole lot of strain in the first quarter unless a lot comes in at March. But January and February were good, well, reasonably, and or should have been. So the weakness that we expect to see in small business credit in the first half of the year will likely come into play more in Q2. So that's a couple of webinars away from now. But we are expecting some weakness, especially among certain industries, and we'll get into those a little bit more later. So looking at the number of new borrowers and how that affects things like the bankruptcy rate, which is calculated based on the number of businesses in bankruptcy rather than being a balance metric. So you should see the poll results, I think, on the right side of your screens now. So the new establishments data that we get from the Bureau of Labor Statistics has a couple quarters worth of a lag. So the reason I wanted to throw this poll question out to our audience was to see what's happening among small businesses right now and how they're reacting to what looks likely to be a pretty severe cash crunch as they face a demand shortfall going in the first half of 2020. So previously, we've seen that, a rising number of new establishments and the associated increase in borrowings has helped to keep bankruptcy rates low over the last couple of years. So somewhat counterintuitively, we would almost expect to see a slight dip in bankruptcies in the first half of this year, just as new borrowers are coming into the small business credit space. So as all of you are seeing an increase in the share of, first-time borrowers or first-time-to-you borrowers of SMEs, we're expecting a slight dip in those bankruptcy and severe delinquency numbers, just as, new businesses, new balances come onto the books and depress some of the old outstanding stuff that had yet to be resolved. So moving on. Again, in the fourth quarter, this is data from the SBA, the U.S. Small Business Administration. Gross approvals had reached a record high of almost $10 billion in the first fiscal quarter, or 2019 Q4. And you'll notice the numbers are mislabeled. It should say approvals are on the left, charge-offs are on the right. We've already corrected this, and you'll see that in the deck that we send out after this presentation. But yeah, new approvals were up to about 10 billion, and the SBA reported that charge-offs were their second lowest on record, falling to about 160 million in the fourth quarter. So up until 2020, we've seen really good performance and improving metrics in small business credit. Like I say, we do expect some of that to change as businesses face a bit of a cash crunch from an unexpected demand shortfall. Looking to the senior loan officer survey. So loan officers were reporting higher demand for C&I lending in Q4, mostly the effect was more pronounced among large and medium-sized firms, but there was a slight uptick in small firms. But you'll notice the dashed line is the 8-period moving average, so you can see on a net basis whether more loan officers are reporting increasing or decreasing demand for C&I lending. And that number has been negative for the last couple of years now. Again, somewhat counterintuitively, the first quarter may actually see this trend reverse as new borrowers come into the small business credit space. So this is something I wanted to highlight from some of our previous webinars, where the SBA introduced a new term option on their lending. So a 25-year loan came into the SBA's portfolio of offerings, and as a result, ever since the beginning of 2018, we've seen a steady increase in the average term on SBA originated loans. So over the last couple of years, small business borrowers have been able to extend the term of their borrowings, which should help them manage their cash flow during a time like right now when a cash shortfall is expected. But we'll see if that's enough. And as Ryan mentioned, there are packages in the works to help cushion the effects of falling demand. So we'll see over the coming quarters how effective that will be, and whether businesses that were able to take advantage of these longer loan terms can sort of better manage their cash during a period of shortfall. So continuing on with the slide, as Ryan was talking about, you can expect hiring is going to slow. And what I'm showing here is from the ADP payroll report, splitting out very small and sort of medium small businesses. So those with 1 to 19 and 20 to 49 employees in the purple and green lines respectively. What did payroll additions look like through 2019? And you can see with the exception of the first quarter, things were pretty flat overall for 2019. So as this cash shortfall hits, as businesses are pulling back hiring, potentially shedding jobs, although again, watch those initial unemployment claims to see if that's happening. But we can see and track how small business employment is affected. And we did see in 2019, as there were issues around confidence, particularly trade-related confidence issues, businesses did pull back on their hiring. So as confidence continues to dip with coronavirus, with the oil price war that's going on, we do expect, there will be some pain seen in these payroll numbers, particularly for the small and medium small businesses over the coming quarters. So returning our attention to the poll question, have your small business clients sought to increase their borrowings? 67% or 2/3 of people said yes, and about 30% said no. So we are seeing strong demand clearly for credit from small business borrowers. Sorry about these pauses. I'm coughing on mute.
Oh no.
Yeah, so small businesses are increasing their borrowings, and so this is somewhat good news for our numbers. We should see, new balances coming online in the next quarter or two as they hit. But the reason, again, for this might be that businesses are expecting a cash shortfall, and they're looking to cover that with borrowings. And again, as Ryan said, there are policies, particularly fiscal policies, coming online, which should help address some of the cash shortfall. Small business incentives have been talked about quite a bit. But I believe as of now, no package has been agreed upon, so what the final version looks like is still up in the air, and that doesn't help confidence at small businesses right now. So moving on, getting back to more of our bread and butter topics, looking at regionally what's going on with small business delinquencies, particularly in the agriculture sector. So the Great Lakes region saw a large uptick, or relatively large uptick in 31 to 90-day delinquencies in the fourth quarter, and really throughout the year, as low ag prices weighed on those ag borrowers in the Great Lakes region, and we'll likely see this continue, even though we do have the Phase 1 trade deal with China that came online coronavirus affecting them, obviously delayed shipments, as I'm sure many of you have read about. Agricultural purchases by China have remained depressed in the first quarter, which hasn't done ag borrowers any good, as a lot of their product from last year even is still sitting in silos and in warehouses. So they're likely to continue being affected into the first quarter. I think before I go to my last slide, did we have one last poll question for my section, Gary?
Yes, we certainly did. We had a regional poll. What regions, is there a particular region that you think would be affected by the coronavirus?
All right, I'll let our audience answer that as I move on to my last slide. And, you all can stop listening to my gravelly voice pretty soon here. All right.
You're doing good.
As with the last, thanks, Gary. As with the last quarter, I wanted to give you all just a taste of the indices we're working on. So since our last webinar, we've continued to make progress working on the industry sub-indices for the performance index. So this one specifically looks at the performance of manufacturing businesses. You can see there's a very large dip after right in the first quarter of 2016. And part of that has to do with a lag coming from the oil price. I guess calling it collapse at this point is a little laughable, but the oil price pressures that were faced in the second half of 2014 and through 2015, as well as 2016 Q1 being set to the reference quarter for this series. So all other periods are in reference to 2016 Q1, which is essentially the zero level. But you'll notice prior to 2016, the manufacturing industry had positive credit performance, and since then their credit performance has deteriorated somewhat in 2016 and 2017, but has been on an uptrend since then. But if we expect, or as we would expect, following the latest oil price pressures from the price war, there may be further pain ahead for small manufacturers and credit extended to them. All right, well, the results of our poll are in, so I'll wrap up with this. Is there a particular region you expect to be most affected by the coronavirus? 36% of respondents said the Far West. The next highest was the Mideast region at 18%, followed by New England at 15%, with the Rocky Mountains being the least affected region at no respondents indicating, or 0% of respondents indicating that was that region would be most affected. I'm going to hand things over since I've already run over my time, but thank you all for listening, and I look forward to meeting with you all next quarter to discuss small business credit. Brody?
All right, thanks, Derek. Hey, so my name's Brody Oldham. I'm our Director of Analytic Consultancy here at Experian, and I always appreciate the insights that Ryan and Derek bring us for the macro review. I also want to give a shout out to my buddy Rick Tran from Experian's Commercial Data Science team for helping me put together some of the trends that we're going to review today. When we look at our small business ecosystem that we've been in over the past several quarters, it's been pretty stable and running at a positive clip. And so that's what we're going to see today in our fourth quarter, see some of those results. And then we'll take a few minutes to look at what risks we're entering into the next few quarters. Now, I travel a lot, and I'm contained. Derek's coughing a little bit. My wife has me contained into my office. But I'm set up here to engage the world, and we're going to take about 20 minutes here and look at some of the strengths our small business lending community has in the fourth quarter, and again, provide some small business insights into the positioning that we have over the next few months. So small business owners' credit health, the consumer side, to me, really plays a great role in how businesses are performing, especially for small businesses. We're going to see some supply chain challenges, some decrease in foot traffic for certain business types, and we kind of talked about that a little bit earlier. We know that in some of the recent studies that we've done here that a high percentage of small business owners are going to use their personal credit when we get into some slower times. One of the buoying factors that we're going to see play out here in the next couple months is going to be inclusive of home values and the ability of a consumer to pull some of that equity out to support cash flow. Now, what we've seen on the consumer market with home prices is that they're trending upward, about 6.8% year over year overall. Consumer mortgage loan originations for banks and credit unions, like we talked about last quarter, have really been accelerating. They're up in the fourth quarter 88% year over year, so pretty good lift there. We've seen some rate relief, certainly recently, and some refinancing options coming out. In Dallas last week, there was a 30-year home loan refinance at 2.8%. Now, I don't know how many of you have seen that before, but that was pretty tremendous. And I dialed. It was almost like dialing to win a radio show because you couldn't get through fast enough to lock in your rate. Pretty exciting time there if you're trying to refinance your house. But for small business owners, that really gives an opportunity to, again, go after some of these additional funds that are out there if there really is some concern in the next 2 months or so to try to stabilize their business, make sure that they have enough credit going into the next few months. Now, consumer credit card originations, again, on that side, when we look at what the consumer card in their wallet versus their commercial, the consumer card originations are up 10% year over year, still very high. They're breaking, in the fourth quarter, they broke the 2008 peak levels that we saw right as the recession was about to hit the last time. So originations are up, personal loans are up, so the availability of a business owner to go out and get a personal loan up 8% year over year in the fourth quarter. What we're seeing lenders begin to do now in the consumer credit criteria is tighten just a little bit. We saw that last quarter as well. But what we're seeing is that where those consumer products are a little tighter, we've seen the commercial space open up a little bit and fill in the gaps. And we're going to talk about some of those areas where the commercial space is filled in. Now, Gary, if you could, let's throw up one of our poll questions on the side while we keep going. How do you feel about what we're going to see? How prepared do you feel as a business lender in the next 2 to 3 months if we see an economic slowdown? And there's a couple things that you'll want to look at here. Do you feel pretty good about your current positioning? Are you preparing and acting on a plan if the signals really become more pronounced? Are you taking action right now in your portfolio? Really want to see how the market's feeling. As Ryan talked a little bit earlier, we're right on the edge. Not quite to setting the baseline for a recession yet. Want to see where you guys are feeling that you are at this point. Now, while we wait on the results, let me take a minute or two here to talk about the commercial trend data that we're going to be highlighting, the specific behaviors that we're going to monitor, and how this should really apply to your marketing activities. Now, we utilize some very granular data that's made up of small businesses with tens of millions of payments a month across a wide array of industries and products. It's called the Small Business Credit Share. It's focused consortium data that includes expanded payment performance data on products like lines of credit, credit cards, loans, leases. It's just a great way to look for signals that are predictive of future originations, payment, and delinquency. And we're going to look at some of those different key points today. Now, these trends play a key role in the signaling of a pullback or a trouble for specific industries, and we're going to point some of those out. And those signals are what we're going to really focus in on. And I'm going to point out a few specifically. We'll show you how the strength and the stability was in the marketplace in the fourth quarter. And then we're going to look at and see where some of those changes are going to occur in a slowdown. So we've got a few more seconds here on our results, so we're going to just keep on going. So as we look at the outlook, insights that Derek and Ryan really presented, we can certainly see that there's a slowdown in the economy coming in the next few months. Most of the economists that I've spoken with too look at these potential trends that if it goes into a recession, it should be lighter and shorter. And Ryan certainly talked to some of the things that can push us out a little bit more easily out of a recessionary period. But we're going to look at some of the industries that are going to feel a little bit more pressure over the next couple months. When we look at the performance of installment loans over the fourth quarter of this past year, what we're going to see in the portfolio of loans that's held by Experian that are originations for these installment type products. And these installment type products are high dollar value, fixed terms payments. They take a little more time for a small business to acquire, more than like a commercial credit card. And what you're going to see on this chart is that the lift in origination volume in the fourth quarter of 2020, you're going to see that seasonal trend is very similar to the origination performance in the previous year. When we look beyond the volumes to the average balances of installment accounts with lower risk, better quality segments, balances increased year over year on average about 23%, so with some good expansion there. The highest risk segments, though, those that you have poor credit quality, they decreased about 5%, and that's going to be important to remember as we go and we look at strategies that different companies are taking as we move forward. So when we look up at our polling question, we see that a lot of you are preparing your action plan as we get closer to recession. Some of you are already taking action. Not many are relying on business as usual. And I will tell you that that's what we see a lot in the numbers here, and so let's keep going. So you can see the change here on the far right, the installment originations as they picked up. We're seeing are a little less risky than the prior quarter. When we look at the quality of installment loans originated as a predictor of long-term performance, this strategy really is the origination of accounts at a lower risk level with lower available balance, and it's a push into less risky paper. Really, that less risky paper is going to have the highest balances on the product sheets. So the risk segments are defined by IntelliScore, and you're going to see the red and the yellow medium high risk bands. And we're seeing an increase in originations. And where we've been seeing a reduction in the previous quarters, it really falls in line with some of the tightening of the consumer paper that we've seen and an education push with small business owners to really utilize commercial products, which we've been highlighting in a lot of our lending presentations that we've given through 2019 is that we want to help business owners look at moving their credit from their consumer credit into their commercial credit, picking up trade lines on each side. That just helps both sides increase your score and prepare that business owner for a slowdown, which we're really coming up into in the next few months. Now, when we look at, you're going to see here that we're changing up a bit. We break these trends down by risk segments and industry. An average balance for each of the industry is noted with a dot with a balance amount posted. You're going to see that in each of the bars. And we see some change in the balance risk in mining. And Derek mentioned this just briefly. As businesses have really seen some global pressure change the landscape of the market, oil prices, we're seeing, we really want to call that out here. It's a good point to make. China, who has been a big consumer of energy, has put parts of their manufacturing on hold later in February, early into March. Their demand for energy has been lower than normal. We're seeing that here as we self-quarantine, that we're not driving to work as much, so our demand for oil is shrinking. That's creating some more supply in the system, and it's helping those barrel prices to lurch down to $30 range, hopefully bringing those back up. And while it's helpful really for the consumer market when we look out there, it's going to impact our construction and energy segments lowering their development and exploration efforts. That really pulls out some of that opportunity in the market for revenues for some of those other types of industries that latch on to the oil industry, certainly where I am down South Texas. So we're going to look at some of the other industries also with that similar global volatility lens as we go forward through the remainder of the insights here. But what I want to really draw your attention to over the next few slides is the space where we see the arrow. This highlights the increased polarization effect in the portfolios. So as the account shifts away from that medium risk paper to more risk in the portfolio, they're really increasing less risky paper being brought in through originations to improve that ratio with some more low risk paper being added into the portfolio, so helping some instability. All right, and you're going to see that across almost all industries when we look at these installment lines of credit or installment loans. Now, the next trend that we're going to look at is commercial installment delinquency trends. You're going to see it broken into regions here. Southwest, you have a focus on energy. West, on supply chain. They're going to run into some, we see it dropping here, but my expectation is that's going to go up in the next quarter here. We're going to see those delinquencies start to trend up. So we'll look for that in the coming quarter. When we look at the average balance risk that we see, again, it's been increasing for overall installment portfolio over the past few quarters, but we're seeing some correction here in the high-risk segments. But what my expectation, again, for this one is that we're going to see these balances continue to come down as the risk levels increase within the portfolio. Now we're going to switch real quick our focus to our line of credit originations. There's a little lag here from the fourth quarter. The trend is expected to slow down year over year. Most of the regions are seeing an average of a 20% decline in originations in line of credit. If we look at originations by risk tier, the balances have dropped even an average of 15%. Not as many small businesses are using the line of credit function. Something that we could, something certainly that could be a value as we're looking forward. One of the things is, Derek mentioned our hypothesis here is that small businesses are looking for some of those longer-term funding options, like the SBA loan that has that 25-year availability. Taking out some of those longer-term facilities can help tamper down some of that volatility that these small businesses will see and help them to stay healthier through a slowdown. Now, when we look at line of credit, you're going to see, as far as originations, the seasonal trends here, we're showing some signs of loosening in the third quarter to address some of the slowing originations that we saw last year. You're going to see in the fourth quarter expanding into some of the higher risk segments, filling in some of the gaps that we're seeing on the consumer side. But more risk added to the books in the highest risk segment, really more than prior years. That's the thing to really focus in on here, a little bit riskier. And then when we look at the portfolios, just like installment loans, when we look at prior quarters, we're going to see some of the portfolios are showing some lightened high-risk balances, but the industries for mining, construction, and transportation are really where the risk that we've seen in the fourth quarter, and we're going to see more of that as we get into our next two quarters here. Now you're going to see that same behavior across, again, the places that we'll see in line of credit. Some heightened risk in the next two quarters are going to be in our service and retail industries. Now we look at delinquencies in line of credit. We're likely going to see some convergence in the 0 to 60-day later stage delinquencies, meaning that those that are in those higher delinquency buckets are likely to roll into a charge-off or default situation. So we're going to continue to watch this to see if we see in the next quarter or two more of that convergence, and the expectation is that we will see that. Utilization has remained fairly stable over the last 24 months. So when we talk about a line of credit and utilization, really my mind goes next into commercial credit cards. And we really have seen a pattern set over the past few years that's very seasonal. We see that balances are really up on average 12% across all risk tiers, and in the highest risk segments in credit cards, they're up 19%. So a pretty good boost here. So originations, we're still cooking in the fourth quarter. Our expectations that we're seeing that, and like you also in your survey question mentioned, that you expect that our small business owners are out there continuing to seek credit. Now, when we look at originations in the commercial credit card products, again, we're going to see some movement toward the less risky segment into the first and second quarters of this year. You can see that start to happen here in that far bar to the right. Now, what you're going to notice here in the industry segments, you're going to see, again, the yellow and orange bars are expanding from the prior 12 months. Industries like mining, construction, and manufacturing are still becoming more and more risky as we go through. And we're going to continue to monitor these portfolios in credit card because, again, these are unsecured products that our expectation is that, you know, if your portfolio is all unsecured, it's a good time to, again, do some account review and look for where the segmentation of your portfolio resides as we go forward. Now, when we look at delinquencies, again, we're seeing it trend up a bit over what we saw in 2018 into 2019. Our expectation is that this will continue to trend upward into the first quarter and certainly in March as we continue forward. When we look at our delinquency rates overall, again, they've been fairly stable for commercial credit. You're going to see that charge-off amount trending up. We should see our later stage delinquencies start to trend up in the first and second quarter, something, again, that we'll monitor as we go forward. Now, when we look at a utilization, this is something I expected to see a little more jump in our fourth quarter as our delinquencies were picking up, as we saw increased originations, that we'd see a little bump in our utilization rate. My expectation is that we're going to see that utilization as credit tightens just a little bit as we get into the second quarter. We should see utilization bump up just a little bit as some of these small business owners are pulling from this credit facility to help maintain some of their cash flow as they're getting a little bit less through the door activity. A little less foot traffic, certainly, in retail. Now, I do want to touch on coronavirus as we kind of wrap up here. We've been preparing as a small business industry for this slowdown for several years. We've been talking about a slowdown in every meeting I can remember for the past 2 years. We've been ramping up as an industry our usage of advanced analytical tools and preparing our account management processes to be more effective to help our customers, the small businesses in our ecosystem, to be healthier as the economy slows. So we're looking for, at the small businesses, how we can help them. And we talked about, how the coronavirus has really gone viral within our ecosystem here for small businesses, creating some market volatility, supply chain disruptions, global recessing economies we see across the world. That's just, it's going to create some pressure. Consumer sentiment, again, we see that, people hoarding toilet paper and hand sanitizer. Those things, they make me giggle a little bit, I have to say. I know that people are stressed out about toilet paper, but some of the things are pretty funny with storage units full of toilet paper. Now, foot traffic is something that we're going to have to watch out for. People have really slowed. Social distancing has really impacted just our local economies. So as we go forward, those are going to be places where we're going to be holding up our local economies, helping those small businesses to survive. Now, like I said, we've been preparing the small business industry as a participant here for several years, really preparing you guys and preparing us to be able to support small business as we go into a slower economic cycle. So this is one of those chances that we get to use some of those account management tools that we put in place, and I'm excited that it's really going to help the industry as we move forward. So what do I want you to take away from our discussion today is that we have a cautious outlook. You know, Derek, Ryan, and I talked about that, you know, we're right on the edge. We know that there's supply chain risks that are going to cause some temporary slowdowns in production over the next 2 months, foot traffic decline, people inside their houses. It's really going to push some of our companies to become more digital in what they do. We'll watch out for the big Amazons and our big digital retail space to really pick up where we've left off. We'll look at some of those brick and mortar stores have a little more difficulty in the next couple months. So something that certainly something to key off of. Consumer lending has been growing through the fourth quarter. We may see it slow down a little bit. Delinquencies really in the commercial market are still pretty low, but our expectation is that they're going to tip up a bit. So our goal here is to really help small businesses thrive. There's going to be some challenges in certain industry, and our goal here is to really help you mitigate risk, but to keep investment in small businesses open and running. So our effort and success is really supporting small businesses through the shutdown, through the slowdown, and this is going to mean a stronger economy and a faster recovery. So I'm really looking to see how we all participate together and really keep these small businesses up and in a healthy state. So I hope this has been helpful. I'm going to turn it back over to Mr. Stockton and to close us out today.
Okay. Thank you very much, Brody. Thanks very much, Derek and Ryan. Really appreciate you guys bringing this insight and helping us today. For more information on Moody's Analytics, folks, so you can always get that out at moodysanalytics.com. We'll certainly put a copy of the recording and send out an email with a link to the deck after we finished, probably later today, early tomorrow. More information, obviously, go to experian.com/B2B for any information. And we will see you back here next time for the Q1 2020 quarterly and the next release of the Main Street Report. Thank you all so much for attending today.